Welcome to part 3. So we're first going to spend a bit of time just talking about how Flagship operates and how we work, and then we'll round off by how these 3 choices will affect your portfolios. So Flagship is an experienced global investment manager. Flagship's first fund was launched in 2001, and it was a global fund. And ever since then, Flagship's main focus has been global. I would say the vast majority of South African asset managers, when they first started investing locally, and later in their timeline, they ventured or started looking at investing globally. So where global investing is our DNA, we think that sets us apart from many of the other SA investment managers. We have a 20-year track record of outperforming the benchmark. We're one of the most awarded boutique asset managers. We're independent, owner managed, and we have flexible strategies, which means we've got the tools necessary to navigate the current markets. Our investment approach, risk management is probably our number one goal or our number one aim. This allows us to, 1, protect client capital, and number 2, removes a lot of the emotion that comes with investing. We are style agnostic, which means when value as a style does well, we can do well. When quality as a style does well, we can do well, and the same with growth and with GARP. We can do well in all the different style scenarios. It also means that we don't define ourselves to looking at just emerging markets or just developed markets. We look globally for the best opportunities and are not constrained in any way. We use a top-down and bottom-up approach. Stanley Druckenmiller and George Soros are extremely successful investors, and they are just top-down only investors. Warren Buffett and Peter Lynch, they bottom-up investors only, and they also have been extremely successful. So we decide we get a lot more information using both top-down and bottom-up. We typically hold 40 to 50 stocks in our portfolio. In the flexible funds, we've noticed that equities over time are the best performing asset class. So we do have a bias towards equities. You could say we are equity centric, but we're also flexible enough, meaning that if we need to, we can reduce that equity allocation quite quickly and quite materially and increase cash allocation. Our decision making is collaborative, which means it's a team approach, and there's not just one person's view that's expressed in the portfolios. And our flat structure means that we are nimble and we can act quickly. This is probably the biggest advantage for a boutique. This is the Flagship Worldwide Flexible Fund and some of the stocks that the fund holds. Now, the first thing I notice when I see this is the great access that the fund has to in global sectors and global companies. And it's just not something that you can get on the JSE. And I say this even if you're in Australia or even if you're in Mexico or if you're anywhere in the world, you need to have access to global sectors and to global companies. I would say it's the main reason we tell people to invest globally. Now, I'm not talking about moving your money offshore. That's a different conversation. I'm talking about taking your rands, investing it with an SA-based fund manager who invests offshore and has a track record of doing so. Starting on the left, looking at the aerospace and defense sectors, our top-down approach quickly highlighted the strong order books that this sector would experience from the Russian-Ukraine war. Our bottom-up analysis tried to sift out those companies which could translate strong order book or revenue growth into strong free cash flow growth. Rheinmetall, the top one there, is a German arms and ammunition manufacturer. Rolls-Royce Holdings, not the car company, but the engine maker, they make engines for defense and commercial aircraft. And RTX is the world's largest manufacturer of guided missiles. In branded pharma, but specifically Novo Nordisk and Eli Lilly, they are the giants which dominate the anti-obesity market. This is quite a nascent and very fast-growing drug category, and we've seen this translate into strong earnings for both those companies. Energy is a very good inflation hedge, and we hold Total and Occidental Petroleum. In China, the fund has exposure to companies which are both cheap and which screen as high quality, and these companies are also growing strongly beyond the domestic borders. Gold, we've spoken about gold and we've shown the good characteristics that gold has, and for now we agree with central banks that gold is a good holding. We also think that when the Fed does decide to drop interest rates, that gold will do even better from here. Looking at our asset allocation in the Worldwide Flexible Fund, we currently have an 85% exposure to equities. Recently, that was about 72%, and we upped that to increasing 12% allocation to SA equities, specifically to SA financials. And that was a tactical asset allocation going into the elections. We were seeing stronger commodities, which would benefit a stronger rand, which would be good for the equity market, especially the SA Inc. equity market, and we had a favorable view on the outcome of the SA elections. Offshore cash, we have 10% in US dollar cash, which is yielding 4 to 5% in interest in dollars. We have gold bullion, which we hold 5%, and another 2% in gold equities. And for now, we have 0% allocation to bonds. We think there will be a time to hold bonds, but for now, we have a 0% allocation. So coming back to the 3 paths that are open to the US, we have assigned what for now is a probability of what we think could happen or should happen in each of those 3 scenarios. Given that it would be an unpopular choice, we think that there's a 10% probability that the US will actually cut debt. If this happens, inflation will fall and bonds will outperform equities. It is worth noting that this will be the same scenario or same outcomes if you have a recession in the US. Inflation will fall and bonds will outperform equities. In the do-nothing approach, which we assign a 60% probability, the economy can still do well, but it will be fragile. Inflation could still persist and the debt burden will still grow, and at some point that could all collapse. So vigilance is required. If there was a need to raise more debt in case there was a pandemic or a financial crisis or something like that, inflation will spike quickly, rates would have to follow quite quickly, and bonds and equities both will underperform whilst energy and commodities will outperform. The 2 main funds of the flexible funds, on the left we have the flagship Worldwide Flexible, or the fund of funds. Since inception, it's a 20-year-old fund, 20-year-old plus fund. It has 13% per annum. Inflation over that period has been 5%. Its benchmark has been inflation plus 5%. So it has outperformed its benchmark by 3% for the last 20 years. On the right, we have the flagship Worldwide Flexible Fund, and that has outperformed its composite benchmark as well as outperforming or in line with inflation plus 5%. So a real return of 5% in that fund. So that's it. I want to thank you for your time and for listening to our views on the US debt problem. Please feel free to contact us if you have any questions or if you just want to get in touch. Thank you very much.